in advance, allowing better planning and infrastructure utilization, and gate scans similarly at our hubs to enable accurate mapping of trucks. All our trucks that move across the country are GPS enabled, real-time tracked 24/7. Strategy 2030, stronger, leaner, innovative, and tech-driven. I'll call on Deepak to walk us through the numbers.
Just give us a minute. Sorry about that. Just give us a few minutes.
Leave it. Put it presentation. Put it slide. I'll do it.
Yeah. Coming back. Is it okay? Okay, coming back to the plan, what Ketan mentioned in detail about integration and how that will add to operation efficiency. Also from 2025, the effort which is done to make the model asset light, how it will pan out in the years ahead. I think this slide talks about that. Here, what we have done in FY25 are the combined numbers of allcargo Gati and supply chain business. That's a subsidiary of allcargo Logistics now on the revenue front. From that, we have removed discontinued operations, which are adding like a drain on a gross margin. So that, which are fuel stations, that business will be closed by next month or so. The agreements are underway of execution. So what will happen, I think the strategy what we discussed to have a stronger, leaner, innovative and tech-driven model, which I think the accelerated focus would be on yield management, I think, which will be through product mix, air, surface combination and all of that, including the contract consultative logistics revenue bump up, which will happen. That will add to enhancement in revenue. So if you see from FY25, nearly 2,000 crore revenue on the combined basis would go up at a CAGR of 10% over up by 28 and going up by 12% by FY30. That will also move in proportion the gross margin, which is actually right now 600 crore going up to by same proportion of revenue. The effect of this will also have on our EBITDA, because what we are targeting to do have a free cash flow model, which will actually enhance in our EBITDA. Also in terms of cost optimization, the focus on SG&A and employee cost rationalization, that will add to EBITDA from the 200 crore of FY25, which will go up significantly by 20% upwards, enhancing the ROC, which is actually right now at a 5% level, going up by nearly 1,000 bips by FY28 and by 2,000 bips by FY30. This is the strategy. It looks difficult, but from the work which is already put in over this last 6 months, and we see more or less achievable. The resultant value creation which we aim in terms of enhancing ROC and making a structured profitable growth on year basis, that's the strategy from current year onwards. So what will happen by this is the pillars which you talked about infrastructure, people, all are, the work is completed. I think what we would aim to make them all stronger, leaner. And the three stakeholders, which are the shareholders or customers and employees, that's the process we started on the Net Promoter Score, where we This year, we are in a bottom or slightly better than the average, but we are sticking a target on that front also to go to a 60 percentile. And also on the employee opinion survey, which is above 80%, which is good, going up to 95%. Notwithstanding, I think the shareholder value is primary in the entire strategy because the main stakeholder. Achieving higher profitability from a combined PBT of 10 crore, achieving a CAGR of over 100% or 150% as we move on till FY30. So that's the quantification of the strategy which we, Ketan, discussed in detail. Over to you, Ketan, to take this slide further.
Thank you. I think that brings us to the end of the presentation. That's the management team. Happy to have Mr. Sushil Rathi now on the dais for the next session, which is Q&A. At the bottom, you have the leaders on sales and operations. We recently onboarded our head of operations for CL, where we had an exit. And these are the partners we work with. As I said earlier, the best of the best. If you pick up the listing of the top 500 companies, you'll see all of them are our partners. So thank you very much for your patient listening, and happy to get into the Q&A session.
The floor is now open for questions. Our hostesses are ready with the mics. Please raise your hands if you have a question. This appears to have been a very comprehensive presentation. No questions, it appears. Oh, we have one.
Hello. So my first question is, before allcargo acquired Gati in 2019, the revenue from the express logistics business was around 1,450 crores. Today, after 5 years of journey with allcargo, we are at 1,500 crores. The profitability has been impacted. Pre-Ind AS, we were 5%. Today, we are 4% post-Ind AS. Just wanted to understand the journey, what kind of difficult decisions that we took to revamp the company, and how this is going to progress further.
Yeah, thanks. Yes, I think it has been a flat journey, we admit that. So that was the intention of putting that revenue slide on the table. What had happened is, in this year, I think the market pre-COVID, post-COVID, we had a bump up on the domestic business. But post-COVID, what we have seen is a fall in terms of various factors, actually, which could be internal to us, maybe putting up right people, that was one thing. But overall, I think, notwithstanding the stagnation or the flatness in the revenue and the gross margin, what we see, the ROC and the EBITDA margin focus, that has been maintained. So if you see in this 5 years, there is no burn on cash flow burn which has happened. We continue to add value in terms of retiring the debt on the company and adding more free cash flow. So if you see the slide which Ketan mentioned, the 5-year effort of shoring up the free cash flow in the company, that has happened. Yes, we compromise that the toll took on revenue. I think now the plan which we have in place, it's visible that the revenue cycle will move up in line with the growth in the GDP horizon, which will be upward of 7% year on year, followed up by 10% with the yield enhancement which we have in plan in place. Also, you want to add, Ketan?
Yeah, surely, Deepak, you covered quite a bit, but Deepak covered it. The top line was stressed, but you saw some green arrows at the bottom of that slide. Culture essentially eats strategy for breakfast, so a lot of cleanup was needed on the people side, on the customer side, enhancing the brand's image, which has happened over the last 3 to 4 years. Infrastructure was upgraded. We added newer hubs. A lot of money was invested. So it's a very, very strong footing that we have now, and the business is at an inflection point, and that's the confidence that we have demonstrated in that slide going into FY30. That would be my take on the question. Thank you for the question.
So my next question is related to automation of warehouses. Just wanted your thoughts. Are we going to spend capex on automizing the large warehouses that we have today? And secondly, we have also focused on creating larger hubs from the smaller hubs that we had earlier. Just wanted to understand that what benefits it is ripening at this moment, and going forward, what will be our focus to improvise the utilization and the yield of the assets?
Yes. So infrastructure, if you, we are in hub and spoke model actually. So as I mentioned, the investment in terms of modernization of all the hubs is already in place actually. All our facilities are grade A rated now. So even if you go ahead in future, we don't see a large outlay in capex happening. Even if you see it's a number of 15-20 crore is actually easily absorbed in terms of, over a period of 5 years, I think if you see 70-75 crore could be investment in modernization of hubs. But with all those gate scan and hub automation, control tower initiatives, which are already, that investment is already happened. So the benefit of all of that is now going to accrue. So it's not that it will add any cash flow drain, but it only add to efficiency and increase in profitability as we go ahead. You want to add?
No, not just to clarify, your question was for the express hubs or the
express
CL
hub.
warehouses? Okay.
The express hubs.
Thank you.
Thank you for taking my question. So my question is on contract logistics business. From Q1 FY25, we undertook a deliberate expansion into newer segments. We were first focused on chemicals. Now we are focused on different autos and ancillaries. So this expansion has led to a decrease in margins in the contract logistics business. So what would be our strategy going forward? Do we expect the margins in the same range, or do we expect it to increase?
That's a difficult one. See, contract logistics or the consultative logistics business, we call it. We have 3-4 segments. Auto, chemicals, as you rightly say, we are the leader in that segment, which is a high margin product. Or the segment category for us. Followed by auto, we have pharma, some bit of FMCG and e-commerce. So the rationale for in FY21 of putting e-commerce as a product was one, the top four e-commerce players in the country, or rather internationally, they were based on our service offering on the chemical sector. They wanted to associate with us, which we started the journey, and now what we have consciously allocated our revenue distribution equally among all these 4 buckets. Margin, as you said, has been consistent. It's not fallen down. I know we can we can discuss offline on this. But all the 3 products, yes, some bit of margin up and there would happen seasonally. But e-commerce, as you know, seasonally the margin impact is more. So that's why you must be seeing that variation. But otherwise, the margin expectation on EBITDA front is uniform across all sectors. I hope I've clarified. Anything, Sushil, you want to add?
If I can just add to what Deepak has said. So primarily, we are into 3 segments very, very clearly. Chemical, we have been a market leader for quite some time. Our next level competition would be at least 40% lower than us in the chemical logistics space. Apart from that, to take advantage of the growing e-commerce segment and the quick commerce segment, we have invested into the people, processes and technology to adopt to that model. And today, some of the large e-com players are our customers, and we are growing that business also pretty strongly. And the third segment, of course, is the automotive and engineering, which is the a segment which has outsourced a lot over a period of time, and that is where a lot of 3PLs have grown. And we have also, tried to catch up on that segment after the, chemical and e-commerce. And now it is a pretty strong segment for us. And this also has helped, and as Deepak said, the margins are actually more or less consistent over a period of time, but we have been able to achieve phenomenal growth in terms of our top line in last 2-3 years.
Thank you.
Can you share some thoughts on your air volume? How much is right now, and how you want to take it up in next 3 to 5 years?
Sure. The air express business grows in low single digit in the country, between 3 to 5%. We want to grow at about 4 to 5 times that market, which will allow us to consistently be the fastest grower in air express and also improve our market share. Half the market today is with a logistics player that has its own aircraft, but the other half of the market is for everybody to kind of chip away at. So that's a very, very big opportunity. Our market share is also currently in single digit. The focus we have brought on the product is seeing increasing market share quarter on quarter, more new business and new customers signing us quarter on quarter. So we're very, very excited about the growth of the air business. Deepak kind of covered it in his presentation, where he said the blended yield of the company also improves much more when a lot of air business enters the system. So we're very focused on how that benefit will also occur to the yield of the company.
Can you share in tonnage terms how much it is right now, and what are your aspirations?
In terms of tonnage, as I said, we will grow by about 20 to 25% consistently. We are at about number 4 position now, and we aspire to take number 2 position in a very, very short period of time, because the gap between 2, 3 and 4 is much easier for us to cover, and we are kind of realizing that with the growth that we are experiencing over the last few quarters.
Can you share some thoughts on in terms of operating fixed line between 2 countries or 2 where it's assured volume full flight?
2 cities, because this is a domestic business. So 2 countries is not something that we are doing. We're not doing any import and export on air freight.
Okay. So thank you very much.
Thank you.
Yeah, there's some questions at the back.
Hi sir, thanks for the opportunity. So just wanted to understand about the competitive scenario. So on one end, you have the new age players who have been going aggressive in the past. So how do you see, where do you see we have the competitive advantage over someone like them? And second, on a longer term, with all this improvement in infrastructures and all, I think a lot of these economy PTL players have also been telling that the turnaround time is going down for them also. So do you see in the medium term there would be a massive differential between an express service as well as an economy service? Thanks.
Yeah, thank you. The only product that all of us deliver to the customer in Express is service quality. And the two very strong pillars of that service quality, one is reach and the second is transit time. We are the strongest in terms of reach. We do 100% of the pin codes. On transit time, we are the best in the industry on nearly 70% of lanes. Our project that should end next week will give us the roadmap which we will execute in the coming quarter to become the leader in terms of transit time. These are the two areas that the customer looks at. Express will continue to grow, and as we have seen in more mature logistics markets globally, as economies mature, and that's what's happening in the country, as they become more and more regularized, as the infrastructure improves, customer expectations improve, Express plays a very important role than the FTL or the economy players. And that is why you will see the large majors in the world call themselves Express also. Apart from that, on the consultative logistics side, we operate a FTL business for retail, for automotive, we do milk runs. So that opportunity will also always be addressable in our playbook. We will not let that go away. The divisions will focus individually on the opportunities in the market, and Express will be a major focus area.
Hello. Hello. Thank you for the opportunity. So, sir, correct me if I'm wrong. Your contract logistic business is currently they have expanded their warehouses capacity from 7 million square feet and plans to add around 3 million square feet over the next 3 years. So, according to some reports, the grade A warehouses is approximately cost around 2,000 per square feet. So the capex is around 600 crores. So I just wanted to understand how you are going to source the capex for the next 3 years, and if possible, provide me the timeline for this capex.
So, as mentioned earlier also by Ketan, we operate on a asset-light model. So we don't construct the warehouse, or we don't buy the land and construct the warehouse, but we take it on long-term lease. And these long-term leases are, commercially negotiated, etc. We may enter into a 3-year, 5-year kind of lease for these grade A warehouses, and which we operate for our customer as a multi-customer, operation in those warehouses. So the only investment which we do inside the warehouse is in the MHEs, racking, etc. And for that also now we have moved into an OPEX-led model, and which helps us in terms of conserving the cash in the company to be utilized for the other growth, and still manage the operation in the best possible manner. So there is technically, hardly any investment which goes into the warehousing, despite we increasing our footprint from current 7 odd million to 10 million in a few years' time.
Thank you, sir.
Just to add, Sushilji, here, even on the BTS model, what we have, all those investment which Sushilji mentioned, which are the residual part, that are also on a buyback commitment with customers. So actually there is no exposure on company. It's pure asset-light product, and any commitment, any investment which is done for a customer is paid back over a period of 3 years to 5 years. So to that extent, there is no, what you said about the CapEx investment, we don't see that happening because that's not our model. Yeah, thank you.
Thanks for the opportunity. Can you just highlight what the debt split will be between the two entities post the demerger? Like how much stays in the All Cargo Global and how much would be with Gati?
So there is a small portion of debt which will come to Gati. That's already documented in the scheme which is approved by shareholders as of 1st October 23. So the residual large part of debt is already repaid by allcargo Logistics over the period of 1.5 to nearly 2 years now. So there will be a residual around 20-30 crore of debt coming in as a part of this business, domestic business to Gati. Hope that clarifies.
And how much will be the number for the global business, in case someone can cover that?
Global business, I think we can have the benefit of Group CFO. Ravi is all there. I think we can have a discussion later.
So I think, in the coming days, we'll also share more precise numbers since the scheme is likely to get approved now in the next couple of weeks. But broadly speaking, on a net basis, Gati would be near, Gati as in the all-cargo logistics with the combined domestic supply chain and the express business would be more or less cash positive, while majority of the net debt which is visible today on the all-cargo logistics consolidated basis, that would sit in all-cargo global. Only a part of that net debt, I would say less than 20-25 crores of the net debt will be on the all-cargo logistics side. Rest all on the console all-cargo, what you see today, goes to all-cargo global.
How much is that number, Ravi, if you have that number handy?
We'll share that number in the coming week or two maybe as we get the approval.
Thank you.
Thank you for the opportunity again. In one of the slides that you have shared today, you have said that the growth and top line would be 10%. Could you bifurcate that in volume and value terms?
Yeah, thanks. I think I covered actually. So there will be two components. One is the consultative logistics part, business. Yeah. So I'm coming to that. So another is an express business. So express volume plays a criteria. So volume growth 7% we have factored over 2 years, coming to increasing by 10% as we move on to FY30. And to top it with the yield enhancement, because yield is one of the I think important component in terms of the extra service charges which we built in. So that will add to another 2% growth on the revenue front on the express. And consultative logistics, as such, the business has been growing at a CAGR of around over 25%. So we expect that to continue in the future. So that is the breakup of the overall revenue increase. That combined effect will be 10 to 12% moving on till 2030.
Fair. And secondly, as majority of the long haul cost has been taken care till now, my thought was that gross margin should have grown at a faster, gross profit should have grown at a faster pace, whereas you have presented that it would be in line with the revenue growth, and the margin expansion in EBITDA terms to reach to 13.5% by 2028 would have components of employee and other expenses, which is not the bigger portion. So just wanted to understand how are we enhancing the journey by not improving our gross margins, whereas improving our EBITDA margins?
Yeah, I think that's a good calculation. So gross margin, yes, we kept it at a steady level, 30%, which actually we have plans to top it up. Line haul cost, which you mentioned, is one of the key component, because it depends on the load factor of volume and the lanes which have to be very efficient. So that toggle around has to happen based on the volume growth. So that we see it happening as we move in the festive season and the year ahead. Coming down to the EBITDA, the improvement is on various counts actually. One is the tech factor, which has built in and reduced dependency on other costs, which would actually have a larger impact as compared to the gross margin. So that we have kept some room there, but I think, as you said, there is a room of improvement there also. Yeah.
What kind of EBITDA per ton we are expecting in surface express business?
So we don't quantify that way, like how in the terminals business do it on the tonnage basis, but EBITDA on a margin, on a percentage basis, we are at from 10 to 15% is what we are looking at for over the period of 5 years now.
So my next question is related to the air express logistic. As you said that you are expecting to grow at 20-25 percentage, means today's volume, which is around 10 to 11,000, which would expected to reach by